Good day, fellow investors. Chemical stocks are down. We discussed some of them already 8-9 months ago when the cycle started to turn down, and now it's time for an update. So on my research platform, you can see my portfolio's 21-day money-back guarantee, but this chemical situation is something that I have been following closer. And here I'm happy to share the latest chemical sector, Dow and other companies' stock analysis, where I think you will get a lot of value from. So we'll discuss the key stocks there. There is one buy which I am looking into it. I can share the analysis now with you. When it comes to the buy and how much I'm buying for my portfolios, that's something, that application of the risk and reward, that's something you can follow on my research platform. Let's dig into the stock-by-stock chemical sector analysis. By the way, this is how I usually approach investing. I can immediately tell the summary. So this is a commodity business. It's impossible to have a durable competitive advantage. Very unlikely. So the cycles get ugly when there is a downturn. In good times, everyone makes money. How to make money? You ride a cycle upturn because then the companies become profitable and then do buybacks, dividends that push a stock price higher. For now, and likely going forward, the name of the game is overcapacity, and if there is US recession, a global slowdown impacted by tariffs in 2026, we are not yet at the bottom of the chemical cycle. If things turn for the better next year, then also these stocks will rebound. That's now the risk and reward for the sector. Also, oil shocks, input prices all play a role in this environment. Now, let's immediately start with Dow. Dow is a bet with an uncertain yield. The stock is lower now, the market capitalization is just 16 billion. The dividend yield is still there, and the company has always been known as a good dividend player. It previously paid $2.8 per share, which means if we return to that, that's a 12% yield, which means the stock will double if the Dow company just returns to normal. On the risk side, however, we have to see whether this downturn is just temporary or it's a bigger issue with more dividends cut ahead. The thing is that 2021 and 2022 have been amazing years, and 2023 for the chemical companies. Amazing years means a lot of cash. What do you do when you have a lot of cash? You invest, because managers are, let's say, exuberant, and they're paid to think about growth and promise you returns as shareholders. So you build new capacity, you invest, you think the market will grow forever, but then just a small slowdown, all this capacity comes online, prices go down, profits disappear, and we have a cycle downturn. If we look at the situation now, this is exactly a cycle downturn. You see here the negatives, negative outlooks. They are trying to save things by saving money, 6 billion, sell assets, etc. Every company in the chemical sector is selling assets. Now, in a downturn, they have been acquiring those assets in the upturn when they were flushed with money, and now they sell it. What can I say? And look, what is the risk and reward? So they want to, save money, rationalize, save this, get some here, some there. But if you are looking at what their main pick for shareholder value is, anticipating lower interest rates, which should foster a recovery in housing and durable goods and markets. That's Dow's presentation. So they are betting everything on a revival on the economy and growth forever. And that's something that I'm not willing to bet when it comes to my portfolio. If that doesn't happen, as I said, if there is a deterioration of the economic situation next year, this will look even uglier. Dow can pay no dividend, which will be the time to check again this company. I don't know how to predict economies or interest rates, but they seem to know, so they should then perhaps work at the Fed, not at the Dow. When we look at the financials, everything is down. So you can see here, sales down 9%, volume not, because they keep their capacity, but that crashes prices, and therefore their margins go down. EBIT goes from 700 million to practically zero for the quarter. If you make zero money, you can switch something from here, put from there to there, but there is the certainty of the interest expense on the debt that you use to make those acquisitions, and therefore operating margins are now very low, 2%, which means that there will be no money. They need to invest 3 billion of capex, and that's not enough. So they should increase the debt just to keep up with the dividends. If they are smart, they would cut the dividend, but if they cut the dividend, the stock price will go even lower. Here you can see how the debt starts increasing, and then we'll see how it works. In short, the company is not profitable. We don't know when it will be. So if it looks ugly, but the best times to buy cyclicals are in ugly times, not great times, because those that bought this in 2022 hopefully have learned their lesson. When it comes to the investing risk reward, yes, if things return normal economically, this is a 2x. If not, you can see another 50% down. So too risky for value investing at this point in time, given the debt. If there is a longer recession or a 2-year chemical downturn, it can go much uglier. Given the debt, no margin of safety. Now let's go a little bit to Europe. BASF had its boom here, but it is seemingly resilient, however also not making money. PE ratio is negative. The dividend yield in line with everyone there. They are a little bit more diversified with agriculture and everything, so not that bad as the clear chemicals, nutrition care, industrial solution, agricultural solutions, which is almost as big as the core business. So that helps them a little bit. Perhaps also things in Europe on the stock market are good, which means the stock hasn't yet deteriorated, but there is still risk. However, they project things to be normal going forward, a little bit lower their guidance, but they are, of course, mainly investing in the Verbund site in Zhejiang in China. That should add approximately 1 billion to EBITDA, but they are increasing the debt. If they build that with low prices in China, the profits will not be zero, and they discuss that, as we'll see in a moment. The debt is 20 billion, 24 billion, so significant debt compared to the situation. And of course, as everyone else, cost-saving programs, etc. Their plan was, during the Capital Markets Day, for a 12 billion distribution, or 3 billion per year over the next 4 years. Given the chemical situation now, I don't think that is sustainable, but there might be IPOs. They try to separate those businesses, so maybe create some value there. However, that doesn't change much. Verbund depends on where the cycle will go. They target higher EBITDA, higher profitability, but they assume mid to upcycle condition. If it's down cycle condition, then it's not good. If we look at analysts, they are pretty positive, but I don't have the same sensations when it comes to the company. I really want to see a recession, a slowdown, and then we can pick up when there is real blood on the streets. For now, everyone still expects things to improve, maintain their financial strength, etc. The current yield on a good year where they can make 4 billion is still 10%, and to buy a cyclical you need the yield to be 20% and the company not to go bankrupt, which means this is too expensive from that perspective. By the way, this I think is on free preview on my platform, so you can read the analysis there. And here you can see also now they have learned that there is a lot of overcapacity after they're finishing building their huge plant. So it was a bet they took, but okay. Lyondell still going strong with that dividend. That's impressive, but I think the market already expecting a dividend cut because it is not sustainable. They filed for bankruptcy in 2008, 2009. So always think about the risks when it comes to these companies. There is a clear contraction in cash flows. There is significant debt, which makes it again risky. The debt is more than 5 times the operating income now. which means bond refinancing and all those things are crazy. Of course, if they make money next year, everything will look great and dividend yield will go to 6% and everybody happy. Lanxess learned this through David Einhorn. We'll discuss it more tomorrow because he has some very interesting ideas. However, look, no dividend yield, no P/E ratio, so cut the dividend yield. However, there is a catalyst that the market doesn't seem to be watching. They will get between 800 million and 1.2 billion euro from selling their stake in the Envalior business that they have already sold 16% a while ago. So there is the value, the market sees no value in the business there, and if that happens, they will lower the debt, and when there is, let's say, a revival of the economy, they should be very, very profitable with low debt, which means have a good valuation. Because they are still doing good on EBITDA, barely positive on cash flows, so not paying dividend like the others, not taking new debt. For the rest, when it comes to valuation, this is from Einhorn. If things improve by 2028, they get to good levels of EBITDA at whatever, it's a double or a triple, but think in 3-4 years from now. I've looked a little bit at some others. Evonik, for example, nothing special. They will plan of growing, also good EBITDA, fairly priced, dividend plus a little bit more when things improve, but there is a lot of debt, which again makes me wary of investing. Guidance has been lowered a little bit. Maybe they will still reach 800 million in free cash flows. Nothing bad, nothing special, could be interesting, like all chemicals in a cycle upturn. Celanese has the highest upside because, ouch, what went wrong here? Well, they acquired DuPont for 11 billion on that. 2 days ago we discussed Kering acquiring JDE Peets. That's what happens when the acquisitions go wrong, that's the risk. And now they are debt at 5.6 times EBITDA, which is very risky. However, they are still free cash flow positive. It looks okay. If they can reach this target of $2 per quarter, they might simply double from the stock price if the debt scare goes away. If not, they might go bankrupt like the other company that we mentioned. Too much debt for value investors, which makes it a bet. Eastman Capital, okay, also down in the downturn, huge debt pile there. DuPont, it's more a specialty chemical, thus priced differently, so different game, and again, fairly valued there. So I'll see what I do and how I approach the sizing, the strategy, the positioning, the timing with Lanxess. The market doesn't value at all the situation now with the catalyst, because the market will start valuing the catalyst only when it happens. Similar story was with Liberty Global, so we'll see how we go about strategy there. Unfortunately, all the others are still too risky despite the downturn. Perhaps next year, perhaps we'll take a look again in 12 months. If there is a recession, you lose 50%. If there is a huge revival, you gain 2x. Not a great risk and reward situation.